What's up everybody? Welcome to the Stocks channel. My name is Cory, and today in the stock market we see the major indices slicing down through some critical support, and it's very important you understand how to manage risk here. First up, let's take a look at a daily chart of the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, today SPY was down 0.73%, and we did get that close below what I told you was critical support at 442, which is also a close below the 50 EMA, so price action is now officially below all of the moving averages, and it does look like the bull trend is starting to get a lot weaker now. So the number one thing you need to understand is when a bull trend is rolling over, it's very important you manage risk well, and the first sign of the bull trend weakening is the loss of that critical support, which we officially have with today's close, which significantly increases the probability that SPY is going down there towards 430. Now I told you that if SPY broke down below critical support, we would instantly get a lot more bearish, so immediately we are going to stop assuming SPY is going to go higher, and we are going to start viewing this as a downtrend while we're below the resistance trend line. Now this does not mean we can't go higher, and this does not mean that we won't go higher. It simply means it's time to manage risk, and it's time to be looking for lower prices until we can clear this resistance zone at 448. So it is possible sometimes that we liquidate long positions below critical support, get all of those buyers out before we start going higher. But if you look at the arrow that I drew, we are going to know when to get back into the market when price action breaks that resistance and we start breaking this downtrend. This is a much simpler way to manage risk, because if we break critical support and you assume that we're going to just bounce and go higher, you are going to lose a lot of money if we just continue to go into free fall and start getting high volume selling. So heed my warning, risk management is very important in trading, and this is the time to be a lot more cautious because we are breaking down below critical support, which while it does not guarantee we are going a lot lower, it is definitely increasingly more likely, which means the odds of going lower are now increasing, which means you need to be prepared for it. It is okay to lose a trade, but it is not okay to let those losses become so large that you blow up your account. So it's much more important to lock in a small loss before it gets a lot larger, knowing that if we see the market turn and start heading higher, we can always get right back on the bull and continue to capture that upside to higher prices. So there is one very important thing we need to talk about today, and that is jumping over to the US 10-year yield. And there's something going on in the bond market that we instantly need to be aware of, and that is that we are now starting to close above the October 2022 highs, which is exactly what put in the bottom of the bear market of last year. So when bonds are dumping, that is usually a warning sign that stocks could be right behind. So this is definitely a warning sign that you don't want to ignore. And this is telling us with SPY breaking down through critical support on the same day the bond yields are starting to break out, that you need to start getting a lot more cautious. Now, one thing to note with the 10-year yields is that when we do peak and we see a pivot from the highs, that has typically been very close to stock market bottoms. And every single one of these pivots in the US 10-year yield has been very great buying opportunities in the stock market, going all the way back to last year. However, we haven't yet seen the pivot, which means in the 10-year yield, we are going to need to see a pivot and a break out of this bull trend, because currently this is going to be a lot of headwinds for equities, especially those high-flying tech stocks that a lot of you love to trade. This is the time to be very cautious as the US 10-year yield is breaking out, because this is a warning sign I would definitely be aware of, so make sure this is on your radar. Another thing to pay attention to is the XLF, which is the financial sector ETF, is currently testing the 200 daily moving average. And again, this is very important that if we are going to stay in this bull trend, that we have healthy financials. And if we see the financials slicing down through the 200 daily moving average, that is just more and more bearish breakdowns and more reason to be very cautious to the downside. So watch the US 10-year yield at the October 2022 highs, and watch the XLF, which is the financial sector ETF, right here at the 200 daily moving average. And those are going to be great indicators of whether or not we're breaking down and we're going to see much lower prices in stocks. Now jumping back over to SPY, how you would translate this to your trading is you need to manage risk around 442, because below 442, I told you I expect to see 430, and this is now our first daily close below 442, which means we could now be entering a downtrend that even if we do get a bounce, which is completely possible, that we could just put in a lower high and continue lower towards 430. So this is how I want to view the market below 442, and this is exactly what I told you we were going to do, that if we started to close below critical support, we were going to start expecting a downtrend towards 430, so that is exactly what we're going to do. Now, if I take the measurement from the absolute high SPY has been to the low we closed today, we are still only down 4.33% from the absolute high. So if you're the worst trader in the world and you are the least luckiest person in the world and you bought the absolute high of the year, you are still only down 4.33%, which is still completely fine to manage risk from. And again, that is if you bought the absolute high and you just sold today at the low. Anywhere between 3 and 7% is still completely normal pullbacks. And even though they're painful in the short term, they don't guarantee that we're done going higher. However, as I always say, let the price action do all the talking. And right now we close below critical support, which means we need the bulls to prove otherwise, which means we're going to need to break through some critical resistance. And we're going to need to get back above some of these moving averages to start getting more bullish. As you can see from the volume, we are starting to see increasing volume, and you don't want to be holding long on a high volume selling day if the volume is going to spike up to above average levels below critical support and we continue to flush, and you did nothing to manage your risk. You are going to have a very miserable time in this market. Again, I am not saying that is going to happen. I am simply saying be prepared for it, which means you shouldn't be over leveraged in longs, and you shouldn't be all in with no cash, and you shouldn't be gambling on long positions in the options market when the chart is telling us to be cautious. So right now, SPY below 442 means we could be coming down towards 438 to 436, and then below that we should be hitting that price target at 430. And 430 is the next critical support, which means below 442, it is possible we're going to continue to put in lower highs and lower lows until we get to 430. Now, to get more bullish, we obviously need to get back above 442 immediately, because one day below it could simply be a liquidation of the longs and we could reclaim that support. But again, wait until this resistance breaks to show proof that we're getting a higher low into a higher high. The higher high breakout is going to at least require a break above 448, and then above that we could be looking for that gap fill above 455, but again, we're going to have to take it day by day. So be very cautious here. Make sure you are managing your risk and you're not just assuming the market is going to go higher. That is very dangerous, and that is completely ignoring what the chart is telling us, and that is completely ignoring price action. On the NASDAQ 100 triple Qs, we were down 1.06% today, and just like SPY, this is the first day closing below this critical support at the 50 EMA, which was that close and breakdown below 366. Again, there is no reason to assume we are going higher when we're getting a bearish breakdown, so below 366, we will be looking for a test of the next critical support lower right around 355 to 357. Now that is a lot closer than the critical support in SPY, but that is because the tech sector is leading the way lower, and the tech sector actually topped out right around the middle of July, whereas SPY recently topped out in August. Now, if you take the absolute high in the triple Qs and you measure to today's low, we have now had a drawdown of 6.58%, which is completely normal because the tech stocks are usually going to be a lot more volatile and they're going to go up higher. And then when they pull back, they're going to pull back deeper. So right now in the triple Qs, you're managing your risk at the breakdown at 366, which while that doesn't mean you need to go panic sell all of your long positions, it definitely means you need to be a lot more cautious, especially with the bond market telling us that we could have a lot of headwinds coming for tech stocks. So again, this is just simple risk management, and this is how you stay profitable. Just focus on managing risk and the rest will work itself out as long as you stay disciplined and you focus on a trade plan that is prepared for either scenario. And right now we are getting the very early warning signs that we could be getting the bearish scenario, so we instantly need to start adapting. Above 366 in the triple Qs, we're looking for resistance right around 371 to 375. If we get back over 375, we're getting back on the bull, and we're likely going to be pushing up into the 380s. But again, wait for price action to prove it. On the Dow Jones, we were down 0.53% today, and the Dow Jones is also closing below our support, which was right here at 350, and you're going to see this same theme across all of the indices because we are now liquidating the longs below support, and the next critical support in the Dow is down here right around 346. Below 346, we're likely going down towards the gap fill at 343 and just above 339. And as I continue to tell you, this does not guarantee we can't bounce. In the short term, we could easily see a bounce to finish out the week, and then we can still continue lower towards those critical support zones later next week. So what you need to be doing is you need to be focused on a trade plan that is managing risk in the event that we continue lower, and not so focused on missing out on a short-term bounce that is likely just going to be a lower high before we continue lower towards critical support. So in the Dow, focus on that critical support at 346, and the upside resistance levels will be 350 and 353. On the Russell 2000 IWM ETF, we were down 1.22% today, and again, we broke the critical support at 188, so instantly getting more risk off and no longer looking for the upside targets targets until we can prove it and break out of this downtrend, which is going to require a break back above about 193 to 195. Now also pay attention to the moving averages are all negatively sloping. Price action is below all of them. So it is very obvious with the break below critical support that we are losing the bull trend and the small caps could be getting ready to roll over, which means you need to manage your risk below 188, which means you're instantly less bullish now that we're below all of these critical levels. The next downside support will be between 182 and 185. And if we break that, we do have gaps to fill to the downside right around 176 and 171. On the ARKK ETF, we were down 2.21% today as we continue lower below the bearish breakdown of 44.5, which means it is possible we're trending lower towards that gap fill right around 36. We're not getting bullish in ARK until we can break back over 44.5 and prove that we're out of the bear market once and for all and reverse this current downtrend. On the VIX, we were up 1.95% today as the VIX is starting to bounce yet again up towards 18, which is exactly where we're going to start seeing high volume selling and fear if the VIX continues higher and we see the VIX pushing up towards 20. Remember, the VIX is a measurement of fear. If the VIX starts spiking and we're breaking critical support, we could easily start to see high volume selling. So pay attention to the VIX and be a little more cautious while it's trading above 15. On Bitcoin, we're currently down 1%, and Bitcoin does look like it's back below all of the moving averages with the price action, which means it could be trending back down towards this critical support zone at 28,000. But if you look at Bitcoin, it is still a very lazy looking pullback, which is more in line with a bull flag within a bull trend. But if we lose this support at 28,000, we're likely coming back down towards the support trend line right around 27,000. So it's up to you if you're a long-term holder of Bitcoin or not, but in the short term, it looks like we could be going to lower prices. On Tesla stock, we were down 3.16% today, and Tesla has officially entered the critical buy zone for the bulls to show up, which is between 225 and 230. I still think there's a good chance Tesla finds support here and starts pushing higher towards the gap fill at 289. But you instantly need to assume this is a falling knife scenario if we lose this support and we continue lower below 225. Below 225, you're looking for support at 214 and just below 208. And if you really want to be conservative, wait to get bullish until we can reclaim a close back over 250 to 255. On Apple stock, we were down 0.5% today, and Apple is extremely close to filling this gap below, which is right there at 175.77. So as I've been saying with the indices, just because we're breaking down does not guarantee we can't get a bounce. And I still think once that gap fills, there's a good chance we're going to see another bounce back up towards 179 to 182. We may not reach as high as 185 because the 50 EMA is rolling over and it's going to continue to move lower the longer Apple trends down. So we'll leave this projection on here a little bit longer because there is a good chance we bounce after the gap fill. But again, we're not necessarily looking for 185. We're more than likely looking for 179 to 182 after we fill the gap below 176. So jumping back over to the S&P 500, today was definitely a sign to be a lot more cautious, breaking down below all of the critical support levels in the indices on the same day that the financial sector is testing the 200 daily moving average, and we continue to see headwinds from the bond market. Don't ignore the bond market and don't forget to manage your risk because the best traders aren't winning 100% of their trades. They're just ensuring their losers are smaller than their winners, and they just continue to repeat that process over and over, and that is how you become a disciplined and profitable trader. This is time to be cautious and manage risk because we are now getting warning signs that we can't ignore, and we are letting the price action do all the talking. So be very cautious over the coming weeks until we can see whether or not this is just a pullback before we break the downtrend. And again, we will see it in the price action and we will have plenty of time to react. It's a lot better to miss a few green days to get some confirmation than it is to blindly hold in what could become high volume selling. You do not want to be caught on the wrong side of high volume selling, and you're going to have a much better time if you just sit in cash and wait for more clarity. If you want to come crush this market, consider joining Bank Trade Alerts or the Stocks Channel Discord server. You can find out how to join either service by clicking on the links below. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.